Welcome subscribers. Here's another video on inventory cards. This one is for first in, first out and identified cost. And we're specifically focusing on application today. So we've got already some videos on the theory aspect for chapters 11 and 12 from the Cambridge VCE Accounting 3rd edition book for units 1 and 2. Today the focus is purely looking at the application of that theory in the context of doing inventory card questions. All right, so we're looking at 11.10 in particular. Now this one has a lot of information given to us at the beginning, like the usual format, and then we have the requirements. So we've got the owner and manager of Lucetti Paints, a business that sells paint and painting equipment, inventory recorded using perpetual system, and inventory cards maintained according to FIFO. Ceiling paint is sold at 77 per can, and we're going to underline that, including $7 of GST. On 1st of August 2025, inventory card showed this balance. So we've got 10 quantities of cost at 35 equaling 350 and 8 items at cost 40 equaling 320. And here's the following transactions during August, from August 1st to August 31st. The first part asks us to record the relevant transactions in the inventory card under both methods, identified cost and FIFO, which is what we're going to do. Right, so on this inventory card, since it's the shorter one, it usually is the FIFO one. I'm going to write FIFO here. IC usually ends up being a little bit longer in terms of the format for the template that they give you. This item is called ceiling paint, and you can refer back to the slide where we had the question. There is no particular supplier details or inventory code given to us, so we're going to leave that blank for this point of time. So we've got 1 August and the balance. So with the balance, I'm working with tight space here, so we might have to shorten up a few things. Try my best to fit it all in. And the first thing we've got is the existing balance that we looked at on the previous slide. Then we've got 8 at 40 and costing total of 320. Now I'm going to look at the different transactions that happened on the previous slide. So starting from the one on the 1st of August, since this is the 1st of August, I'm going to continue here. The details of the source documents given to us. So receipt 321. We've got an out of 10, 35, 350. So all of this is pretty much gone. And then we've got, I'll just erase that. Then we've got the next line item. I'm going to use a different color here. 5 left of the cost of 40, and 5 into 40, we've got 200. So ultimately, we've got 15 items going out, 10 of the existing one, and then 5 of this second line item that we had at $40 each. So in this case, what we've got left is 3 at $40, and that gives us 120. Next, let's just use the same red. And next we've got 8th of August. 8th of August. I'm going to check 186. Now please remember that we're looking at the transactions in terms of what's going in and what's going out. In the theory video, please refer back to that if you're unsure what sort of items will reflect movement of inventory into the business versus what sort of items will reflect the movement out of the business. So check 186. We've got incoming of 4 at 40 and got 160 here, leaving us with, so we had the 3 plus 4, that's given us 7 at 40, total of 280. So to get to this total, simply multiply the quantity with the cost, and that should give you the total. So far, till 8th of August, we've still got the same single line of inventory coming in and out of the business. So what's left off anyway. Next, you've got 19th of August. You've got memo 20. And memo 20, the effect of that transaction is 2 out at 40, total of 80, leaving us with 7 minus 2, 5. And again, you multiply these two to get 200. Let's continue on the 25th of August. I've got invoice 901, and this time round I've got 10 incoming at 45, so 450, and now that leaves me with this line item that I'll carry forward. So 10 at 45 will be after this. And so we've got the 5 at the 40 cost with total of 200, 10 items at 45 cost, total of 450. Then you've got the next transaction. So you leave this whole row. We've got the next transaction on the 27th. Credit note 25. And here we've got 2 out at 45, 90. So 5 still the same. Okay, we're not changing anything with the 5 because only 45 ones, the item at $45 is being impacted. So we've got the 5, 40, 200, and then 10 minus 2, 8. 8, 45, 360. Remember here the assumption in first is first in, first out, unless there is a specific identification of what's going in and out of the business. But in this case, that's how we're doing it thus far. Okay, so like this example, the out was what was existing from before, is gone out, then you're using up the next one. Usually FIFO, like we covered in the theory part, is more for perishable items. Okay, moving on. Next we've got 2 more transactions left, one on the 28th. So invoice 309, and now you've got for that 5, value is 40 for each, 200, and 1 of the 45. Now that leaves us with, so all 5 here gone, so that cancels out, and it leaves us with 8 minus 1, 7 of the 45, total up 405. Then the last one on the 31st, got a memo 21, 3 going out at 45 because that's the only one that's left. So 7 minus 3, you're left with 4 at 45 and 180. That's our FIFO card. So what we have here is a slightly bigger table than the one we've looked at before. And this one, like I said before, usually is for identified cost. So we're going to write identified cost here. And the item remains the same, ceiling paint. So 1st of August, so I erase that, write it a bit more neatly. 1st of August. Now start out with the same thing, 10 at 35, 350, and you've got the 8 at 43.20. Now 1st of August transaction, the other one, so that's your balance. Now the other one, which was the receipt, and the receipt number was 231. And this template is a little bit short to write on, but I'll try my best to write as accurately as possible and fit it in the space that we have. So 7, 35, 245, we've got 8, 40, and 320. And simple difference between this IC method that we've done versus the FIFO method transaction treatment that we did before, that I've got here on the right hand side. See how we still have the same transaction. We have sold 15 cans of paint, and we've still got the same receipt number, but it says identified cost specifically when we were doing that. So 7 at 35, remainder at 40, right? So that's why we've got identified cost 7 at 35, remainder, we sold 15, so 15 minus 7, 8 at 40. Versus when you did the FIFO, you've said, okay, I need to sell 15. What have I got from earlier? What did I purchase first? And the assumption is in times of rising prices, you would have purchased the cheaper goods first, right? Because over a period of time, because of the cost of living, etc., the prices of those goods increased. So you sold off all 10 of the 35, and then the remaining 15 minus 10 equal to 5 of the additional ones you had to sell are sold off at the $40 cost. That's the difference between FIFO versus IC. Now continuing with that, you paid electricity bill. Do we have to worry about it? No. So you obviously eliminate the transactions that you do not need to worry about. Next, on 5th, you paid wages. Do we have to worry about that? No. We're only recording inventory movements here. 8th. That's the next one we worry about. So on the 8th, what happened? Purchase 4 cans of paint for 44, inclusive of GST. Check 186. So here we've got 4, 40, 160. And now what do we have? So from this, we had 3 at 35 still. So that's what we've got left. So in this one, 335, total of 105. Now the next one, you've still got to carry this. But now you have an additional one. Okay. And then we've got a memo 20 on the 19th, because the next transactions after this, 9th, Gia withdrew $400 cash, nothing to do with inventory movement. On the 12th, received a loan, again, nothing to do with inventory movement. 16th, nothing to do with inventory movement. 19th, Gia took 2 cans of paint to use on home renovations, and we've got a memo, identified cost information, 2 at 35. So now what do we do? We've got 19th, memo 20, okay, remember we had 3 here, 2 gone, what's left? 1 at 35. And then we've got 22nd, you paid wages. Again, you don't have to worry about that. No inventory movement. 25th, you purchase 10 cans of paint, 45 plus 450 GST. Again, GST has got nothing to do with the inventory cost. We do not include it in the inventory cost. If you sell or purchase something, GST liability gets impacted. So if you sell something, you're liable to pay the GST associated with that to ATO. If you purchase something, your liability to ATO decreases because you've just paid to the supplier for that GST impact. Okay, so we've got 25th. Yeah. And you purchase 10 at 45. 450. So now we're going to have 3 line items. 1, 2, and 3. Okay, now that we have that, let's look at what's next. So 27th, you purchased, returned 2 cans of paint, purchased on 25th due to leakage. Credit note 25. So credit note 25, 2 out, purchase at 45. So you've got 90 here. Again, when carrying forward, we'll have 1, 4, and 8 of this left. So 160, and you have 8, 45, 360. Okay, what's next? 28. Sold 6 cans of paint, identified 2 at 40, remainder at 45. Information that's given to us. So it tells you 2 at 40, remainder at 45. And total you sold 6. So there's 4 others to be sold. So 4 others to be sold at 45. 180. So now if I look at the balance, I've still got the 1 and 35. I've got 2 left at 40. I've got 4 left at 45. Okay, last but not the least, physical count revealed 4 cans of paint on hand. I see identified 1 at 35, 2 at 45 was missing. So now my memo So now I'm going to have that memo 21, the physical count. So it says 1 at 35 and 2 and 45 is missing. So 1, 35, 2 at 45. So we're left with 2 at 40 still. And the 35 one's missing, so that's gone. And we're left with 2 at 45. 90. And that's the end of our inventory card. So that should tell you the difference between the two treatments of FIFO versus IC, and you can go back and look at the completed inventory card for FIFO and see what the differences are, like we've highlighted here for the treatment of assumption of FIFO versus when we know we're using identified cost method. Part B asks us what are the two benefits that GR derives by recording these transactions in the inventory cards. Now, one is, of course, we can identify which item is moving really fast or moving really slow. And the second benefit being we can identify the cost price of inventory or whether we need to reorder. So definitely cost price, that what did we purchase it at, what's happening with the trend in prices, etc. Second, if we have too much lying on hand, so it's slow moving inventory, we know we don't need to reorder it perhaps again or discount it so as to better manage what's sitting in our warehouse. Or if it's very fast moving, then it allows us to set a threshold at if it goes below this particular point in terms of the quantity, then we immediately need to reorder more and have X amount of items for this inventory sitting in our warehouse at all times. All right, and next we're going to do the cash receipts journal. So it says record the relevant transactions for August 2025 in the journals of Lucheri Paints. Let's do that. Now we're going to go through the transactions. Again, have your book open with you so you can refer back to the question again and again. On the 1st of August, we had sales, right? So remember, those sales is going to get us some money in the bank. And that's what we have here, 1st of August. Receipt number 231. This time you're using the selling price. Okay. So what you're doing is using this information given at the top of the question. Ceiling paint is sold for 77 per can, including 7 GST. That's what you're using there. Sold 1155, and you've got, let's just erase that, and then you've got the sales. Some portion of it, remember, goes to the GST. So this includes 7 GST. Okay, so next, there was another transaction which was impacting our cash receipts. That was on the 12th of August, where we received a loan from JH Finance for 5,000. Another receipt. Okay, so usually you can see the pattern here. It's the receipts that we are really concerned about with respect to the cash receipts journal. So we had the 5,000, and it's not a sale. There's no GST component. It goes into the sundries column. And then you just basically add it up vertically, each one of the columns, and that's what I've done there. And then you have it. So you have your cash receipts journal done. Next, cash payment journal. Here we're going to be worried about mostly the checks. So let's have a look at what all checks we have in the information. So starting with the 3rd of August, you had electricity bill amount going out. I'm going to write that here. Electricity 184. Bank, you had this amount as 140 plus 14 GST. So together the total is going out of your books, and you've got sundries 140, GST 14. Okay, because it's not for wages or drawings, and definitely not for inventory. Next, you've got the 5th of August, wages, it's electricity, wages 185, that's 780 here, and that's it. So you've got just the wages. The other 780 to balance it out will be out of the bank. And what for? For the wages. Then you've got the 8th, where you have the check 186. This one's for inventory. $186. You've got 176. Remember, it's 4 cans of paint for 44 inclusive of GST. So 160 and 16. We'll split it up. Then on the 9th, we've got drawings. So I've just gone ahead and completed this table. So on the 9th, we had drawings. GI withdrew 400 cash for personal use. Put drawings in there, $400, $400 in banks and drawings. Then on the 16th, you've got paid for 40, including $40 GST for advertising. So that's what we've done here. Bank out is for 40, and we have split that up into sundries and GST. Then we've got on the 22nd, you've got paid wages again, 620, which is what we've done. Bank is again 620. That's what's going away from the bank, and wages 620. And then you add it up together, each one of the columns vertically. That is your part C completed. Then we've got the next one. So sorry, not part C completed with the previous slide. We still have these journals left to do. So we've got the purchases and the sales journal now. Okay, so I think there was some error with the print of the book at the time this question was made. Hence, the supplier's name is missing in the accounts payable. But from August 25, see where it says purchase 10 cans of paint. Usually it should give you the name. So the name was Splash Limited. Now in the reprint, this would be there, but in the actual question, when this print edition came out, it was missing. So August 25th, we've got invoice 901, inventory 450, GST 45, bill payable 495. Then we've got August 28th. Again, this had an error where it says sold 6 cans of paint, invoice 309. The name of the customer was missing. The customer's name was Industry Paints. August 28th, 309, 420. 42,462. Now, part D says, referring to one accounting assumption, explain why the transaction on 19 August must be recorded in the inventory card. So 19 August, we had the drawings where Gia took 2 cans of paint to use on the home renovation. So the clear reason for that is that we have this assumption called the accounting entity, and as part of that, the business and owner as separate accounting entities, and thus any transactions between them must be recorded. So Gia took the business inventory home for her personal use. Therefore, that transaction must be recorded in the records of Lucetti Paints. Then you've got part E, which is assuming FIFO. Explain the effect on owner's equity at 31st of August if the transaction on 19th August had not been recorded. So what if this particular transaction of drawings would not have been recorded? First of all, it's important to recognize overall there would have been no effect on owner's equity if this transaction was not recorded, because it would have been picked up by the physical count as an inventory loss at the end. Therefore, instead of being recorded as drawings, it would have been recorded as inventory loss, which would have also had the same negative effect on owner's equity. Because remember, if you have inventory loss, your owner's equity is decreasing, but at the end, that's something that gets picked up at the end with the physical count. Whereas if you had recorded 19th of August, you would have known that drawings is the actual reason why owner's equity is going down at that point, and would have been picked up a little bit more in a timely fashion rather than at the end with the physical count. Then you've got part F, which is calculating of gross profit on ceiling paint for August 2025 using IC and FIFO. So with this one, you'd have to refer to the inventory cards, but for FIFO, these are the transactions we're picking: 350 plus 200 plus 200 plus 45 is equal to 550 plus 245, which gives us 795. So here 795. Again, if you're not sure, look at the theory for the way we've discussed how to calculate cost of sales with our inventory cards. So next, you've got FIFO. We are using gross profit. Now gross profit, we've got sales minus cost of sales, which we've calculated here. So you've got sales is 1050 plus 420, okay, minus 795, which is 1470 minus 795, which gives you 695. Okay, so that's using FIFO. And the same thing now, but using IC. So IC 245 plus 320 plus 80. Let's do that one again. Oops. Okay, but plus 80 plus 180, 565 plus 260, which would give us 825. Now calculating gross profit, same formula again. you would get 1050, 420, which would have given you, so this was minus 825, would have given you 1470 minus 825, gross profit 645. So comparing the gross profit, FIFO obviously gives us a little bit higher gross profit. Remember, cost of sales in FIFO will always be lower in times of rising prices. So just remember, you have to pick out information here from different journals or different documents. Like for the cost of sales, you would have picked up information from inventory cards. Then for the sales, which is in the calculation of gross profit, you would have picked up from, let's say, the cash receipts journal as well as the sales journal, and then taken away your calculated cost of sales. So this was the end of our application question. Hopefully this video helps understand what are the different working parts when it comes to solving such an elaborate question for inventory, using inventory cards, looking at the theory, the benefits of recording in inventory cards, accounting assumptions that are applicable, impact on, let's say, the different elements of accounting equation like the owner's equity, and then finally calculating the gross profit. Right. Stay on the lookout for another video that's coming out very soon, which will be for application for chapter 12. All the very best. Take care and have a lovely day.